$100,000. It felt unreal, exciting, and honestly a little terrifying because suddenly the question wasn't how to save money anymore. It was, what the hell do I do with it now? But before you rush into anything, I want to be clear about one thing. This video isn't about quick wins or flashy bets. Every decision you make with this money matters, and the goal here is to help you choose a strategy that actually fits your risk tolerance and your long-term goals. I'm going to walk you through a simple 7-step framework that can help protect and grow your 100K over time. And if this kind of content helps you think more clearly about money, hit like and subscribe so you don't miss what's coming next. The first thing I learned is that investing only makes sense when it's tied to a real goal, because money without a purpose tends to get misused, and different goals require completely different strategies. If you're thinking about your kid's education someday, a 529 plan can make a lot of sense because of the tax advantages, while retirement-focused goals are usually better served by accounts like a 401k or an IRA that are built exactly for that. If your dream is buying a home, you might want growth with less volatility than an all-stock portfolio. And if passive income is the goal, dividend-paying stocks or funds may fit better. Time horizon matters just as much as the goal itself. When the goal is short-term, safety becomes more important than growth, which is where things like bonds or CDs come in because the risk is low and the money is predictable. For long-term goals, stocks, mutual funds, and ETFs offer higher potential returns thanks to compound growth. And one thing people forget is that life changes. Your goals will shift, which means your asset allocation should too. And reviewing and adjusting your plan regularly isn't optional, it's part of investing responsibly. The second lesson is painfully simple but incredibly powerful. Start investing as early as possible. Time is the most valuable asset you have, and delaying your investments costs you more than most people realize, because every year you wait is a year of potential growth you never get back. That's why I had to learn to cut back on short-term spending and stop chasing instant gratification. Buying things that feel good today rarely helps you long-term. When you invest early, compound interest starts working for you instead of against you. A longer time horizon also means you can handle more risk because your portfolio has time to recover from market swings. And over time, that ability to absorb volatility can lead to significantly higher returns. Early investing doesn't just grow your money, it gives you flexibility and peace of mind later. Before putting all your money to work, though, you need a solid emergency fund. This was non-negotiable for me. An emergency fund is your financial safety net when life does what life always does, whether that's job loss, medical bills, car repairs, or unexpected debt, and none of these should force you to sell investments at the worst possible time. I keep my emergency fund in a high-yield savings account because the goal isn't to get rich, it's to protect my purchasing power while keeping the money accessible. Liquidity matters here. You need to be able to access this cash quickly and without penalties. The discipline part is just as important because this money is only for real emergencies, not vacations or impulse buys. And if I ever have to use it, rebuilding it becomes my top priority. Once that foundation is set, diversification becomes your best friend. Diversification is how you reduce risk without giving up growth. Instead of betting everything on one idea, you spread your money across different assets so no single event can destroy your portfolio. That means holding a mix of stocks, bonds, maybe some real estate exposure, and possibly a small allocation to crypto or gold depending on your risk tolerance. But it doesn't stop there. Even within stocks, diversification matters, because large-cap, mid-cap, and small-cap companies behave differently. U.S. and international markets don't always move in sync, and industries like tech, healthcare, and energy react differently to economic changes. When one area struggles, another often carries the weight, and that balance is what keeps your portfolio stable. Taxes were something I completely underestimated early on. Taxes can quietly eat away at your returns if you ignore them, while smart tax planning can make your 100K work a lot harder without taking on extra risk. Choosing the right retirement accounts is a big part of that, because with Roth accounts, you pay taxes now and withdraw tax-free later, while with traditional accounts, you delay taxes until retirement. And the right choice depends on your current income and what you expect taxes to look like in the future. Capital gains taxes matter more than people think because selling assets at a profit triggers taxes, while holding investments longer can qualify you for lower long-term capital gains rates. A good tax strategy looks at your entire financial picture, not just investments, but also income, real estate, and even future inheritance planning. Keeping more of what you earn is just as important as earning it in the first place. Consistency turned out to be one of the hardest and most important habits to build. Investing isn't about timing the market, it's about staying in the market. Regular investing prevents procrastination and keeps your money from sitting idle because financial discipline shows up in small decisions made consistently over time. That also means reviewing your progress and adjusting when necessary. Goals evolve, income changes, and markets shift. On top of that, increasing your income can be just as powerful as investing well, because developing new skills, advancing your career, or creating additional income streams gives you more capital to reinvest and accelerates everything. Finally, there's no shame in asking for help. If you can afford it, hiring a financial advisor can be a smart move, especially for areas you're not confident in. Because a good advisor helps you build a personalized strategy that aligns with your goals, protects your assets from unnecessary risk and taxes, and plans for how you'll eventually withdraw and pass on your wealth. They can help optimize taxes during retirement and create an estate plan that benefits the next generation, which is something most people don't think about until it's too late. At the end of the day, financial success isn't a destination, it's an ongoing journey. You have to keep learning, adapting, and staying humble. Discipline matters. Avoid FOMO, stay consistent. Thanks for watching, and I'll see you in the next video.